Welcome to Make a Difference with RJ channel.
Hello everyone. Today we are going to cover Capital Market Expectations, Part 1, CFA Level 3 core syllabus. We are going to cover this chapter in 3 sections. In the first part, we will see why do we need to formulate capital market expectations, steps in formulating CME, and when we try to formulate, what problems do we face. Second section will cover calculations and different approaches to market forecasting. Section 3 will cover business cycles, inflation, and its impact on formulating CME, impact of monetary and fiscal policies on formulating CME. So why do we need to formulate capital market expectations? Let us say you have a client who needs to advise on investing money. For this client, you need to decide what assets will he invest in. What will be the allocation in each asset? So to decide asset allocations, first thing we will need is to forecast expected return and expected risk for each assets and correlation among these assets. So in simple word, CME means finding out expected returns and risks for assets and correlations among assets. Before we look at steps in formulating CME, there are two important points to consider: cross-sectional consistency and intertemporal consistency. So what is the first point? Cross-sectional consistency means consistency across different asset classes. Suppose you go to market to buy apples and you find two different types of apple baskets. One is big size apple, small, and another is small size apple basket. Both have same price. So do you wonder why is that? You might wonder why does small apple also has the same price as big size apple? Should it not have less? In stock market, suppose you formulate returns for different assets, like equity market return. Large cap equity has a 7%, you formulate CME and it has 7% return. And small cap equity has also 7% return after considering macroeconomic condition. Do you think large cap equity and small cap equity should have similar returns? Since small cap has more risk, should it not have higher return? Likewise, you formulate government bond and corporate bond return. Both have different returns. One has 3%, corporate bond has 8%. Now, this looks right. As corporate bond has more risk, so it has more return. So, cross-sectional consistency means if similar assets have similar values, then it should have similar assumptions and similar prices. But if there is a difference between them, then it should have different values. Second point is intertemporal consistency. Consider you have created a long-term goal of eating healthy food, and one weekend you go out with your friends and they are having pizza. So eating pizza will not be intertemporal consistency because it creates problem for your long-term goal. So similarly, formulating long-term horizon return, but you change return after market crash is not intertemporal consistency. So formulating return and risk for asset across time, and if you have investment horizon of clients 10 years, you formulate CME where return for equity class is 10%. But after 6 months, you formulate CME and you change the equity return. That is not consistent with intertemporal consistency. 7 steps in formulating CME. So anytime you need to create return and risk forecast for assets, you need to do following things. First step is determine for which asset do you need CME and what is the time horizon. Now I'm going to take one example so that we learn all these 7 steps along with this example. Suppose I have a client for whom I need to formulate CME for two asset classes, equity and bond, and for the Indian market and for 10 years time horizon. So second step is finding out historical performance and drivers of growth. So from the first example, first step, I learned that I need equity and bond return and risk for the Indian market and for 10 years. So for the second step, I need to get data, past data of 10 years return for both assets, equity and bond. Also, I need a data on why did equity performed so well? What are the drivers of the return? Was it technological growth? What type of macro condition made it possible? So all these things I need to gather in the second step. Third step is identifying valuation model. So for the second step, I gathered data. Now for creating a return and risk, formulating return and risk for equity, which model will I use? Will I use linear regression, Gordon growth model, or something else? That is the third step. The fourth step is determining the best sources of data. So which source of data is best? Is it NSE website or data from any other website? Fifth step is use experience and judgment to determine input value and current condition. In this step, subjectivity is needed. So is market euphoric or depressed? Will it stay same? Should I use the last year data or to project next few years? Or do I need to normalize the data? Sixth step is the most important. So now you have all the information needed, you have the model, you have the data, you have the judgment, you have decided whether you're going to use 3 years data, 5 years data, and this is the step where you actually forecast return and risk. Also record assumptions, whatever the assumptions you have used. Like we have used normalized data and not last year's data, assuming the market was in euphoria stage. And the last seventh step, is monitor performance and provide feedback to improve performance for the next time. Forecasting is like looking into the mirror and asking for answers for the future. Poor forecasts can result in inappropriate asset allocation. So analyst needs to be aware of problems in forecasting. And this is the very, very important thing. There are 9 problems. I'm listing all, but I will discuss only 3, as those are the most important and probability of questions coming from these 3 are high. But of course, you need to read about all the problems. So the first problem is collecting economic data. We will learn later that macroeconomic data is very important determining growth trend, and growth trend is important for forecasting returns for different type of assets like equity, bond, real estate. So while we collect economic data, we face following challenges. Time lag between collection and distribution of data is long. So let us say we collect macroeconomic data from Ministry of Finance or National Statistical Offices. They don't publish recent data immediately. Sometimes there is a lag of 1 year or 2 years. The next problem is data is often revised, and revised data is not published immediately. And the third problem is data indexes are rebased over time. Second big problem with collecting data is data measurement errors and biases. First error is transcription error. This is very common error. This error occurs when someone records wrong value or there is a typing or recording error. Second error is survivorship bias. Remember, this is not a psychological bias, which is also a problem in forecasting. This is a data related problem. This occurs when historical records of manager or firm or a company is deleted. Data of only those companies or managers who have survived is there. That is why name is survivorship bias. And the third point is appraisal data. Now, we have learned about this in second level. This happens when there is a liquid asset, which has infrequent price record. So, for example, real estate. The data is not available for the real estate sale. So data is appraised, which means data points are made up. The third is limitations using historical estimates. Regime change. What is regime change? When you have historical data with a long time, and there is a possibility of time when market crash has happened, or political changes has happened, or there is a regulatory or technological change. So data needs to be adjusted for these changes, and that's called regime change. And the second point here is non-stationary data problem, which is in the long time period, data we have learned about the normalization, normal bell curve. So the mean and variance of the data has changed. So then it is difficult to do the statistic on these data. That's why it is non-stationary data problem. Let us take question number 1 here. We have a Lima, and a Lima is a market strategist at the firm who manages ultra high net worth individual. Lima must gather data from different sources to formulate CME for different markets, different asset classes. He finds many problems with the data and needs to correct it, including following errors. Correct typing errors such as standard deviation 35.1, somebody has recorded 35.1, which should be 13.5. Second is get returns from index data when many composite companies have gone out of business. And the third problem he does is record correct standard deviation of real estate funds because of smoothing of data. So the question is here, identify one limitation of historical estimates and two measurement errors. Justify each response with one reason based on the information given. Remember, our question here is Lima is a market strategist at the firm who is managing ultra high net worth individual. And this question is a return question. So essay type of question. Okay. So here we have three problems. He has gathered, data, but it has errors, typing errors. It has some problems with the data where the companies have gone out of business. And the third is recording of the smoothing of data is there. Okay, so in the first question, we have limitation of historical estimate. We saw that there are three errors. There must be two errors from the data measurement errors, and one must be historical estimate error. Remember, you're not going to have this kind of a very easy questions, and you're not going to have such a small paragraph also. You will have to read maybe one page, one whole page, or two pages, and then find out which were the historical estimate and the data measurement errors. So in the first one, I'm just going to tell you how to write this kind of essay answers. In this first one, we have already understood that the error is a regime change. So you don't need to write the whole sentence for it. You just write regime change. And the second get return from index data, you just need to copy from your question and paste it. Second one is, of course, there are two errors. The first error is transcription error. So just write transcription error, copy and paste correct typing errors such as standard deviation 31.5 to 13.5, just copy and paste. And the second error is appraisal of data. Again, just write appraisal data and copy and paste. Now let's take the question number 2. I have analyst would like to forecast Indian equity returns. She is considering using either the last 4 years historical annual returns or the last 40 years of historical annual returns. Remember which are the two types of historical errors happens. One is regime change and another is non-stationary data. So this is a part of regime change. Of course, because the long time horizon, you will have lot of historical changes, political changes, technological progress, different things, and that is going to create a problem. So we cannot use this 40 years of data. We will need to do a lot of adjustment. That's why the answer should be historical estimate and regime change. Use the regime change word and use 4 years historical data. So now we are going towards the second section in the CME part 1, growth trend calculations and market forecast approaches. Growth trend of any country is important. Why is that? Remember in second level, we learn that ultimately businesses will grow along with economy in tandem. Here we are talking about long-term growth. In short-term, business cycles are there, which we will see in later part of the video. So how can we forecast long-term economic growth. Growth rate forecasting has three parts: labor input, capital per worker, and total factor productivity. So these three terms will decide growth rate of any economy. Labor input also has two things: labor force and labor participation. So the labor input will be decided by the labor force growth in the labor force and labor participation growth. Okay. Now assume that the population is expected to grow by 1%. I'm just taking one example, random example. Here we have the population growth will be by 1%. Labor force participation is expected to grow 0.5%. If spending on new capital input is projected to grow at 5%, and total factor productivity will grow by 0.75%. Now, what is the long-term projected growth rate for this economy? It's very easy, just add all of it and we get growth rate of 7.25%. In the previous slide, we learned how to calculate growth rate of any economy. That is the starting point to forecast equity return because the businesses will grow as per the growth rate of any economy. Nominal GDP growth can be calculated from the previous slide, which is we talked about labor input, capital per worker, and TFP. Okay. Nominal GDP, remember, is inflation plus the real GDP. And the second term here is how much earning will grow as the percentage of GDP. So earning by GDP. And the third term is how much price will change as a percentage of GDP. Sorry, percentage of earnings. So these three terms will tell us the market value of equity for that economy. Let us take an example here. We will do the calculation of market value of equity. Following information is available for X country. Labor input growth for this country is 0.45%. Labor productivity growth is 2%. Inflation is 4%. Long-term change in earning to GDP is 0%. And long-term change in price to earning is 0.15%. So, okay. So real GDP is labor input growth plus labor productivity growth. We have 2.45%. Nominal GDP is equal to real GDP plus inflation. So that will be 2.45% plus 4% inflation, that is 6.45%. And market value of equity would be, now we will add all these three terms: nominal GDP plus price to GDP and price to earning, and that would be 6.6%. So far, we learned that growth rate of an economy is very important. That is the starting point to decide equity return and business growth. But this growth trend can change, sometimes slowly and sometimes suddenly, due to shocks. There are two types of shocks: endogenous shocks, which are internal shocks or anticipated event. Market prices are built in for these changes. And there are exogenous shocks that are anticipated, unanticipated events outside normal event. We can call it surprises. But there can be good or bad surprises. Things like technological progress, political event where government who create good policies or changes in government policies which are good for economy, and are also discovery of natural resources are all good event. These shocks can cause statistical change or regime change. So here I have listed 7 exogenous shocks. Market forecasting. There are 3 approaches discussed in this section. But why do we need these approaches to forecast market? Because we have already learned that in economy, if we calculate economic growth rate using labor input and labor productivity, that is the growth rate of the market. But do you think finance people can just be happy with one way of doing? Okay, just kidding. Relying solely on just one way of calculating growth may provide an incomplete picture of the economy's future trajectory. That's why we have these following 3 approaches. So the first approach in market forecasting is econometric model. This model uses economic variables like income, consumption, prices, employment rate. Remember in level 1 we did linear regression. So yes, we can use the linear regression model and find economic growth using all these inputs like income, consumption, prices, employment rate. So what are the advantages of using this model? Many variables can be used. Once a model is created, it can be reused and output is qualified and based on consistent relationship. Disadvantage, do you remember linear regression, multiple regression, arch? So yes, these models are complex and it takes time to build. The model is complex and time consuming to build. Data may be difficult to forecast and relationship among the data can change. Second approach in market forecasting is economic indicators. These indicators are statistics that help measure how well an economy is doing. Indicators are used by government, businesses, and there are many. Example, GDP, unemployment rate, consumer price index, inflation rate, interest rate, trade balance, housing statistics. All these are economic indicators and they are readily available. What are the advantages of this model? Economic indicators are simple and easy to interpret, data easily available, and can be tailored to your needs. Disadvantage, economic indicator may give false signals. Indicators are revised frequently due to short-term business cycles. And the third is checklist. Checklist is mixed approach where people use indicators, different models, judgment, experience. And advantage of this approach is it is less complex than econometric model, flexible because it uses mixing of different approaches. But disadvantage, it's subjective and time consuming. We are coming towards the third section of CME, okay, business phases and inflation and how it impacts on the CME. There are five business phases. Look at it carefully. We have initial recovery, early expansion, late expansion, slowdown, and contraction. In each phases, our three things, stock prices, bond yield, and inflation, that needs to be tracked for the business phases are doing different things. And let me tell you the trick to remember what all these three things are doing.
I'm going to take a very silly example here. Imagine that there are three people who like to run. And what happens when you run? Initially, when you start running, your heartbeats are slow. As you run, heartbeat starts increasing. After some time, you feel hot. Your heartbeats are very, very high. Then you slow down. As you slow down, your heartbeat starts decreasing. Eventually, you cool down. So now imagine we have these three people. One is stock market, second is bond yield, third is inflation. Also imagine that all three are running, but they start running at different time. Stock market is always starting first, then bond yield follows stock market, and inflation is behind both. Remember this story when we go to the next slide. So we have now five phases. Remember the story I told you in the last slide? Initial recovery period. Here, stock price start rising. That means it starts running. But at the same time, bond yield is bottoming and inflation is declining because both of these are behind stock market. Now look at the early expansion phase. Stock market starts rising now because it's cool enough. Bond yield stable but maybe rising, and inflation is low, so still not rising. At the last expansion stage, here stock market is at the peak. So it has run, from early expansion to the late expansion, it has run and it is run to the course. So it's very hot now and maybe volatile. But bond yield was running behind it, so still rising. Inflation is still rising. Now comes the fourth phase, slowdown. Here stock price starts falling because of, remember, very hot heartbeats, and bond yield was behind it, so it is still rising, inflation is still rising. And the last stage, contraction, here stock prices it's cooled down and it starts rising. But bond yield is falling now because it was rising in the last phase, and inflation, it was rising in the last phase, so now it is at the top, very hot. So remember all these five things and how each and everything, all the stock prices, bond yield, and inflation react in these five phases. Inflation and short-term interest rates are in five phases. Look at it. Inflation is declining, then it is at the bottom, and then it starts increasing in the late expansion stage, and in the slowdown, it is very, very high. Contraction phase also, it is at the peak. In the short-term interest rate acts a little bit out-tuned to the inflation. It is low at the first, it starts increasing in the early expansion stage, then it peaks at slowdown. And in the contraction phase, short-term interest rates are declining. Now let us look at the impact of inflation on asset classes return. Inflation within expectation is good. It is good for equity as businesses grow. It is good for real estate, but it doesn't have much impact on cash though. But when inflation is above expectation or below expectation, both are bad for equity and businesses. It has positive impact on real estate though. So when inflation is above expectation, investor would hold cash and real estate. But when it is below expectation, investor would hold only real estate. What happens when there is a deflation? Deflation means either no growth or slowdown in growth. This is bad for both assets, equity and real estate. But it is good for bond and cash. So investor would hold either cash or bond when there is a deflation. And fiscal policy. Monetary policy, why needed, and Taylor rule. Fiscal policy, how does it work? And yield curve. In previous levels, we have learned about monetary policy. We know that it is counter-cyclical measure by government. If economy is hot, so to curb it, government increases short-term interest rate. Interest rate increases, business decreases borrowing and spending money on expansion. So inflation decrease and we curb the hot economy. Opposite happens when growth is low. Then to spur businesses, government decrease rate. That will increase growth, inflation and prices. So to forecast growth trend of economy, monetary policy can give us clue as to what will happen next in business cycle. If we have following data like GDP, current and growth trend, inflation target by government, GDP expected and inflation expected, then we can use Taylor rule to get nominal short-term interest rate. See, so if we have GDP, expected GDP is going to go up, then short-term interest rate will increase. If inflation is expected to go up, obviously again short-term interest rate will increase. So this Taylor rule will give us the get nominal short-term interest rate. Fiscal policy. So fiscal policy is implemented by government to stimulate economy, or if the economy is very hot, then to curb it down. So by implementing loose fiscal policy, government decreases tax, increases spending. That will actually stimulate economy. And opposite, when inflation is high, then government will increase taxes and decrease spending. Itself does not actually matter for us in CME. What matter is what is the yield curve is doing. Yield curve is used as economy predictor. Yield curve is steep. If yield curve is steep, then economy will grow, which means both the policies, monetary and fiscal policies, are stimulative. If the yield curve is inverted, then economy will contract, which means both the policies are restrictive. Now, if yield curve is flat, then economy implications are less clear. Maybe one of the policies stimulative and other is restrictive, We can use this in the reverse order also. If we see that if both the policies are stimulative, then we can predict that yield curve is going to be steep and economy will grow. At the same time, if we see that if both the policies are restrictive, then it is possible that economy of that country will contract and yield curve would be inverted. What is the meaning of yield curve is steep? That means low short-term interest rates are low and the long-term interest rates are high. Yield curve is inverted, opposite thing happens. So then you change your asset allocation according to that. So I have created a mind map and you can download mind map PDF from the link given in the description. See you in the next video. Don't forget to comment, like and subscribe.